Good morning or good afternoon. Thank you for joining us for our webinar today on buying real estate with IRA and non-IRA partners. My name is Larissa Greene, and I'm joined by my coworker, Corey Daharsh, and we'll be talking to you today about not only the different structures of investments that you can make, but the rules and when you're partnering with IRA and non-IRA partners, what are the moving parts? And so we are going to talk about the rules because it's important to understand why there's moving parts when you're talking about these types of structures. So this is going to be a great webinar. I think Corey and I talked about how we often get these questions, and so we wanted to make sure to cover this in a webinar so that we can share it, share the information not just today, but we can share the webinar in the future when people ask us how these deals will work. So that's just a little bit about what we're going to be talking about today. Again, my name is Larissa Greene. I've been with Advanta since 2011, so almost 11 years, or actually right at the 11-year mark. And I do education and business development for Advanta, but I also have done new accounts and transactions. I did check coding for income received by IRAs and helped IRAs pay expenses. And so I've done a little bit all around the board for Advanta IRA in my time here with the company. How are you doing today, Corey?
Hey Larissa, I'm doing quite well. Thank you for working with me on this webinar. Like Larissa said, I've been with Advanta myself since 2016, so going on my 6th year right now. I spent about 5 years on the client account management side, so actually having a roster of about 1,000 clients assigned to me and processing their day-to-day transactions, answering their questions about these IRS rules and regulations for alternative investing. So I've got a wealth of knowledge and experience in how people use these accounts and different strategies, and I'm happy to share that with you guys today on this topic of partnering your IRA for real estate. So as Larissa said, feel free to reach out to either of us if you have any questions. We do put out a lot of webinars like this and do a lot of varying content. So we're both very knowledgeable at many different things above and beyond what today's topic is. But Larissa, thanks for having me, and go ahead and take it on to the next slide.
Great, thank you, Corey. Before we go on, I just wanted to mention that we are going to take questions throughout the webinar. If you look at the control panel that helped you get onto the webinar, you'll see there's a question box. We do keep everybody muted for the sake of the recording, but please do feel free to type your questions into the question box and we'll make sure to answer them throughout the webinar. And we'll allow just a few seconds at the end for anybody who missed an opportunity to ask questions as well. We also uploaded the slides as a handout. So if you want a PDF of the slides to follow along or take notes, or for future reference, if you look again at the control panel for the webinar, you'll see handouts, and it is loaded there as a PDF.
And real quick, before you jump into the About Advanta slide, Larissa, someone did post, and I think they may have posted it right as we got started. Has the webinar started? I'm unable to hear. So if someone could just do us a favor and post a question there to make sure you are hearing us. It looks like the individual that posted that has left. So I don't know if they just had their mic or speaker on mute. Loud and clear. Thank you very much. All right, we're good to go.
Okay, great. So a little bit about Advanta. We have been in business almost 20 years. Actually, next year will be our 20-year mark, and we've only always handled self-directed retirement accounts. So we are in the business to hold alternative assets for our clients. We don't hold anything market-based at all. And so we sort of do the opposite of what our competitors do. We hold the account, you find the investment, and we help you make the investment in the name of the retirement account. We also do your IRS reporting. We have 2 offices. We're in the Tampa Bay area of Florida, and then we're also in Atlanta, Georgia. All of our corporate office, sort of back office work is done in the Tampa Bay office, and in Atlanta, we have a team there that does marketing and classes. And then Corey, of course, is actually in North Carolina. So we're sort of all over the place, but we can help clients nationwide and even worldwide. So if you're not near one of our local offices or near one of our representatives, that's okay. We can still help you. Most everything, as you guys know, now is done by DocuSign or some sort of e-signature program, as well as by fax or email. And so we have clients, like I said, that are nationwide and even worldwide. If you have a US-based retirement account, we can help you self-direct that account, just keeping in mind that we don't sell any investments at all. It's up to you as the account holder to put your retirement account to work for you. We have a little over $2 billion in assets under management. And we help clients, and I think we're over 8,000 clients now, probably much over 8,000. I really don't know the number at this point, but we've grown a lot. But as we've grown, we've made sure that our clients receive dedicated account managers for their account so that they get concierge style personal service from us. What that means is that once you open an account, you have an account manager with us for the life of your account, and that individual helps you with everything from paying expenses on behalf of your investments to making annual contributions and any transaction or investment above and beyond. And so that's a little bit about us. Uh, just a little bit about what we don't do is we don't provide any investment tax or legal advice. You can certainly ask the question, but if we can't answer it, we will let you know and maybe refer you to a professional that have helped our clients with those questions in the past. We do talk a lot about the rules, and sometimes we'll talk about why there might be a gray area involved. And actually, we might be talking a little bit about that today. And so, if you're looking for a legal opinion, we certainly can refer you to attorneys that can assist our clients. But we're not going to say, hey, this is a good investment, or that's a great return, or this is um, how this works, and you can definitely do this, even though it's considered a gray area. That is going to be completely between you and your professional team. But again, if you have that question, you're not sure if we can answer it, feel free to ask it and we will let you know. A lot of times when we talk about the rules and deal structures, it seems like a lot of information. So we like to give key takeaway points for everybody so that you can see, although we're kind of discussing this topic today, if you have more questions on it, or if in 6 months you decide that you wanted to do a deal structured similar to the ones we're going to talk about today, you don't have to remember all of this. You simply reach out to myself or Corey and have a discussion with us. So just some key points here. There are many unique ways to structure a real estate investment with retirement funds. So this isn't the right way, this isn't the only way. And as I mentioned, in some instances, you may need a legal opinion in order to help you structure those deals. All cash flow must remain consistent with the ownership percentage in the deal. So again, we're talking about IRA and non-IRA partnerships and how that works. So you want to make sure that you're consistent with the percentage of ownership in the deal. We'll talk more about that. And then retirement accounts can partner with disqualified persons on a deal, but still no sweat equity is allowed. And again, we're going to talk about that. But even if your IRA only owns 1% of the deal, if somebody that's considered disqualified to you and your retirement account owns the other 99%, you still cannot do any or perform any sweat equity on that deal. If that other partner is not a disqualified person, because your IRA is involved, you still cannot perform sweat equity on that project. So just be aware of that. Oops, skipped a little ahead. Sorry about that, guys. So what is a self-directed IRA? Well, our definition of a self-directed IRA is something very specific. A lot of times people will say to me, and probably to Corey as well, Corey, you may hear this a lot, well, I have a self-directed IRA. It's with a brokerage firm and I get to choose the investments. But we're talking about something way more specific than that, because brokerage firms are still selling you market-based investments. And again, we don't sell anything, but we also don't hold anything within the market. Everything that we hold is considered a private investment. So investing in 123 Main Street, the IRA actually getting a deed for the purchase, or lending money. So with a note and mortgage or a note and deed of trust. These are all considered private investments, limited partnerships, sometimes REITs. I know you can invest in REITs on the market, but when we're talking about a real estate investment trust, we're talking about something privately held. We see clients holding gold and silver bars and coins, cryptocurrencies. They are involved in futures trading through their retirement account, and the list really sort of does go on and on. It's just the idea behind it is that we can hold anything within IRS rules in a retirement account outside of the market. A reason you haven't heard of self-directed retirement accounts, very simply, is that there's not a lot of us like Advanta out there. Most retirement accounts are held by brokerage firms, and actually less than 4% of all retirement accounts, including 401ks and 403bs, are truly self-directed into private investments. And just something to note, guys, this is not an all or nothing strategy. And so you don't have to move over the entirety of your retirement account in order to self-direct. You can move over just a portion in order to make an investment that you're looking at. And actually, that's what most people do. I would say, wouldn't you say so, Corey?
Yeah, I would say that it's definitely a diversification tool. One other thing I just actually wanted to mention, I did some research last week in the retirement industry in the US. The last time I researched it was at a $27 trillion point. As of, I think, earlier this year, 2022, quarter one, the retirement account industry in the US is at $37 trillion. So to put that into perspective, only 4% of that $37 trillion at this point right now is being utilized for these types of strategies and investment options. So it's definitely something that's not well known, but it's definitely something that a lot of people could take better advantage of once they hear these types of webinars and kind of get some of the education that Advanta provides for free.
So that is, a reason that you may not have heard of self-directed retirement accounts. There is a lot of brokerage firms out there, but there's not a whole lot of competitors to Advanta that will hold these accounts. And I think also at some time or another, brokerage firms may have held a limited number of private investments, but really, to my knowledge, they just don't really anymore. I can even remember clients coming over to us from a brokerage firm that used to hold certain private investments and basically said to their clients, we just don't want to hold these anymore. Brokerage firms typically consider private investments hard to value, and they also don't want to be responsible for paying expenses on behalf of something like a piece of real estate, for example, or receiving mortgage income on behalf of an investment in a retirement account. So that is probably why you haven't heard about it. Self-directed plans, a lot of times when I meet people, they say, well, I don't have a Roth IRA, and so I can't self-direct my retirement account. I'm not really sure where that comes from. But the truth is that if it ends in IRA, it can be self-directed. And so you see up here, the most common retirement accounts are going to be traditional and Roth IRAs, but we can also help you with SEPs and simple IRAs as well. Those are employers' plans for small businesses. We can also help you with an individual K or solo 401k plan. We do hold solo 401k plans. It's a great plan for self-employed individuals. And so if it's you and a spouse or you and a business partner or a few partners, then you can have a solo 401k. And we actually have webinars dedicated directly to solo 401ks and any type of retirement plan for small businesses like Simples and SEPs. And so if you're interested in those, you could always reach out to Corey or myself, and we can email you those webinars so you can take a look. We also can help you with former employer plans, and there's emphasis there on former because once you've severed ties with the employer, you're no longer participating in that plan, then you can certainly roll it over to an IRA to self-direct it. Some current employers plans do have some rules that would allow you to do so, but that would be specific to the plan. So if you are currently employed and participating in that 401k or 403b, you just want to check with the plan administrator to see if you are eligible to move any of that money out to an IRA. You'll also notice I have health savings accounts listed here as well as education savings accounts, and those accounts can also be self-directed utilizing the same rules as IRAs, and so we can hold those accounts for you as well.
And Larissa, I just wanted to add one other thing as well to that effect regarding the current employer plans. If you're in a position where you think you might be able to roll over from your current employer and you're just not sure, that's something that Larissa and I are very happy to help with. We'll either speak with you and outline the types of questions you should be asking that current employer when you reach the benefits or retirement department, or we can even schedule the call together to help you with it and be on the line with them. So those are just some of the things we do to help you move on to the next step and potentially move forward with those current employer plans, just to determine if that's even possible in your scenario.
That's a good point, Corey. Thank you. So why do people choose to self-direct? Very simply, a new source of capital. They didn't know they had access to their retirement account in order to make private investments, and so they would like to access that cash. And let's be honest, retirement accounts tend to be the most liquid asset we have. It's very easy to cash out of stocks, bonds, and mutual funds most of the time in order to make a new investment. And so accessing those accounts and moving over what you want for the next investment is something that is now possible or has been possible, but people are now learning it's possible. And so they want to do that. Stock market fatigue. I think we can all sort of agree that as of late, it's been very exhausting watching the stock market. And so, another reason to diversify and look for private investments, and that happens a lot with our clients. And then, of course, the tax benefits, investing in things that would normally be taxed to you personally, but now using the retirement account to make those investments and um, get the rewards of the tax-free or tax-deferred investing that a retirement account allows. What choices do I have? Well, we already sort of talked about how a self-directed IRA allows just about anything. So I always like to say that the sky is just about the limit with a self-directed IRA. And the important thing to know is the rules for self-directing. So as long as you understand the rules, you can make just about any investment. The only asset classes that are not allowed are going to be life insurance and collectibles. And then really the restrictions have to do more with who you're investing with. So you can't lend yourself money, for example, and the list goes on from there. And Corey will talk to us a little bit about that. And again, the reason that this will be important to you is understanding when you're structuring a deal with IRA and non-IRA partners, because sometimes you have those people that are considered disqualified in a deal, and you want to understand who is disqualified and how you can structure the deal so that it's within the rules. And so we'll let Corey go over disqualified persons in just a moment. But you can see on this slide here, we're talking about the different real estate options in an IRA. So of course, buying and holding real estate, whether that's long-term or short-term, joint venturing, option contracts in real estate, lending, tax deeds, investing into limited partnerships or syndications. These are all possible when you're talking about investing through a retirement account.
All
And so
right.
I'm going to let Corey talk to you about prohibited transactions and disqualified persons.
Yep. Thank you very much, Larissa. So one thing Larissa mentioned on that last slide is investing with disqualified persons, or, who is a disqualified person, just for the manner of understanding it more thoroughly. Today's webinar, because we're talking about partnering IRAs with real estate, it's important to understand who disqualified persons are. And then I'm going to further elaborate how you can actually do these types of deals with disqualified persons, given the proper scenarios are in place. So just as a basic ground rule, a disqualified person, as it relates to your retirement account, would be yourself and your spouse, as well as anyone on your lineal family tree. So your parents, your grandparents, your children, your grandchildren. Any businesses or entities owned or controlled by any of those persons are also disqualified. So if you own a business 50% or more, or make the day-to-day operational decisions of a business, that business is a disqualified entity from your retirement account to invest with. Others referenced there would be along this line, but it's just key to know the lineal tree and your spouse, as well as yourself, are the general disqualified persons from your retirement account investing. And this is to say you can't buy a piece of property from any of these individuals. Your grandfather can't own a piece of property in his IRA and lend it to your son, or let your son rent it out for their personal home or residence. Those are disqualified transactions or prohibited transactions based on the disqualified persons rules set forth by the IRS. Now, the basics of partnering, which is the key point that we're talking about today in this webinar, is that a retirement account is allowed to partner on a deal with either individuals, limited liability companies, real estate investment trusts, or any type of trust for that matter, and other retirement accounts. The retirement account can also partner with disqualified persons as long as the investment is made together at the onset, and the ownership percentage is actually set forth at the onset of the investment, so that all of the funds going into the deal from point blank are based off of that ownership percentage that is set forth. And one other thing to mention that we'll cover a little bit in our case studies later on is that you should consider some structuring options to ease the record keeping because of this ownership percentage rule. So you could set up an LLC and actually buy the real estate within the LLC. You could do a joint venture agreement or set up a real estate investment trust. Those are all strategies and structures for real estate investing. Again, we can talk to you on a one-to-one basis and figure out what your goals are and what your best strategy would be. You could also speak with a legal professional or a tax professional for some of those matters. We have referral partners, as Larissa earlier in the webinar that we could prepare and provide you with. But that's just all things that you should keep in mind when you're thinking about partnering your account for a real estate deal.
That's a good point. And also, Corey, we did have a question pop up about disqualified persons. And I think that this is one we probably all get a lot. I have a domestic partner, not married. Are they disqualified? And the answer is probably. If you really wanted to get a legal opinion on this, you certainly could. What you want to keep in mind is, the disqualified persons actually kind of go out from just our tree there with the lineal ascendants and descendants, and here's why. The IRS rules actually say that there can be no current benefit to you, the IRA holder, or persons considered disqualified. And so if you're doing a deal where maybe you're lending money, for example, to your domestic partner, is there a benefit to you for doing so? And without knowing the structure of the deal, I would say probably. I don't know if there's a scenario where you could lend money to a domestic partner and not have it be a part of a current benefit to you. But again, certainly you could get a legal opinion on that, and we would definitely encourage you to do so. The other thing too is at the time that the person becomes a disqualified person, and so let's say that you and your domestic partner have been living together and decide to get married, now that person is considered disqualified, and that deal, if it's still in the IRA, would be considered a prohibited transaction. So there's no grace period, for example, that says, oh, well, once you get married, you have, 30 days for your domestic partner to and now spouse to pay back that money. So that's not really how it works. And so I would say that although this is sort of my opinion, I do think that you would really have to look at the current benefit there and see if there's a current benefit to you, which is part of IRS rules. And if you feel like, yeah, we could definitely structure this where there's no current benefit, then I would strongly suggest getting a legal opinion.
Thank you very much, Larissa. And one thing you mentioned at the tail end of that explanation is something I actually did go through in my client account manager days. I had domestic partners that were interested in doing a loan to each other, and I really just had to have the honest conversation with them about their plans for the future. And in this case scenario, they were planning for one of the partners to loan the other person money for a time period of 3 years. But they were planning within the next 2 years to get married, and they did disclose that to me. So to that effect, I kind of had to explain exactly as Larissa just said. Given that plan is to ultimately get married, maybe not now when this deal or loan is taking place, but in the future before the expectation payoff and closure of the investment, that would result in it being a disqualified transaction at the point that marriage occurred. So they did decide to go a different route. They didn't tie themselves up in any potentially gray area scenarios. But it's just something to be mindful of if you are in that position with a domestic partner, what your plans are long term, how that may fit into the deal with the transaction that you're thinking about. And again, having that conversation openly and honestly with your tax preparer, your strategist, your Advanta representative, just to make sure that you're not getting into any potentially disqualified areas.
And we had another question pop up about prohibited transactions. If you don't pay yourself, can you do work on the property? So if the IRA, again, remember guys, if the IRA only owns 1%, you still cannot perform any sweat equity on that property. And whether or not you pay yourself is not a part of this equation. It's still prohibited to provide the sweat equity. So if you have, a can of red paint, you say, I would really like to have that rental property have a red door. You cannot go out and paint the door, even though you don't plan on having your IRA and its partners pay you. That would still be considered prohibited. So just be very mindful of that. Now, there's nothing that says you have to hire a general contractor, for example, to do the painting of the property. And so if you're going to hire a handyman, as long as they're not considered a disqualified person to you, then you can hire that individual and have the IRA and its partners pay that individual for the work done on the property.
All right, and I see two questions have come up. Let me just get through this slide and on to the next one. I think will be a good point to stop for these two newer questions. Everyone please asking your questions. We will answer them as we go. I just think the next slide will be a little bit more relevant to those two questions I see popping up. So just to get back on track with the actual content here on partnering, if you're planning to partner for either rentals, fix and flips, raw land, or other general real estate transactions, as I mentioned on that last slide, the ownership percentage is in direct correlation with each partner's dollar amount contribution towards the overall purchase price. So when the property is purchased at the closing table, the deed is going to be listed and the buyers are going to be listed. And something along this line, Advanta IRA, for the benefit of John Smith's IRA, account number 1234, as to an X undivided interest, and Jane Doe, which could also be replaced with Advanta IRA for the benefit of Jane Doe, John Smith as an individual, a number of different things as we referenced earlier, as to Y% undivided interest. Obviously speaking, that has to add up to 100%. And if it's, round numbers, $100,000 property, those are going to be the exact ownership percentage that all income and expenses must be flowing through moving forward with this property. So if you buy a $100,000 property 50-50 and you have to put a $10,000 roof on a year later, well, $5,000 has to come from John Smith's IRA and $5,000 has to come from Jane Doe to furnish that new roof and pay that vendor that's putting it on there. Now, a few more key points here on partnering basics. The IRA company, Advanta in this case, can only receive income on behalf of the IRA partners. So if you're having rental income come in, we should only be receiving the rental income that's going into the retirement account, not necessarily all of the income for us to then disperse back out to Jane Doe, her portion. That is part of the reason some people choose to use a checkbook control strategy or an LLC strategy, which we'll talk about a little bit more a little bit later. And also another thing that I don't think is explicitly on any slides, but some people choose to actually employ a property management firm. That is an option you have where they handle the direct cash flow and send any residual proceeds back to the investors. That would be Jane Doe and John Smith's IRA account. That is your discretion as the account holder. There is a cost to the property manager for doing that. So some people try to cut down on that overhead and don't want to have that property manager there. But some people actually find it as a means to ease the record keeping, as I mentioned earlier in the slide deck as well. So a few other things like paying the expenses I just referenced, tenants paying rent checks. Partnering with yourself is a gray area like Larissa and I referenced, and we would implore you to seek legal counsel. And if you are partnering with disqualified persons, that ownership percentage is locked from the point you go to the closing table and close on the property. You can't buy a disqualified person out on a property and they can't purchase any ownership from you if they are a disqualified person. Going back to the questions in today's question box, I think that was actually one of the questions that was asked. That's why I wanted to hold to this slide. Let me read it directly. Can I purchase a real estate property from a disqualified person, such as a daughter, to use it as a rental? And again, that answer is no. If that person is disqualified, or even yourself as a disqualified person for that matter, that basically from the IRS's perspective prohibits that property from ever being held within your retirement account. Now, you may think, before I explain it further, oh, well, what if my daughter sells the property to Jane Doe, and then Jane Doe, who's not a disqualified person, sells the property to my IRA? Well, if you're ever audited in the future, the IRS would see that as a step transaction or an arm's length transaction, and they would ultimately determine that to be only done to get around the rule and regulation, a workaround or a loophole, if you will, and that in itself is disqualified. So the penalties and fines for disqualified transactions or prohibited items is pretty hefty. We definitely would implore you not to go down that type of route and just find other ways within the rules and regulations that could work for your scenario that you're looking to do. Let's go,
And
Larissa, and just go through a few of these other questions real quick before I jump
yeah,
into the first case study.
yep, Corey, that's a great idea. So we did have a question that pops up, and as you said, it does pertain to this slide. Can you partner your IRA if you have checkbook control with you as a single member and manager of the LLC. You can partner with your checkbook IRA. However, you cannot partner into the LLC that's already formed and owned by your IRA. So just be mindful of that. So for example, if you own Sunshine LLC in your retirement account, the member information must stay the same, but you certainly could partner Sunshine LLC with yourself personally. So let's say that in this example, I was going to buy a property, then on the deed, on the titling, it would say Sunshine LLC as to a 50% undivided interest and Larissa Greene as to a 50% undivided interest. So it is going to call those out. Now you can get down a rabbit hole in this deal structuring and say that maybe the IRA LLC partners into another LLC with you personally and so on and so forth. But just to keep it sweet, nice and clean, then you would say your IRA owned LLC and you personally are now partnering in the deal. You cannot add yourself personally to the LLC your IRA already owns. Another thing is that Corey mentioned partnering with yourself is a gray area, and we suggest seeking legal advice. Why is this gray? Well, remember that current benefit rule that we talked about a few slides ago, where the IRS says there can't be a current benefit to you as the IRA account holder or anybody considered disqualified. And so if you're using IRA funds because you don't have the rest of the money you need for a deal personally, and you must use the IRA in order to make that deal work, that could be considered a prohibited transaction. That is a benefit to you of IRA money, and therefore that is why it, depending on the deal and what the structure is, that could be a prohibited transaction, and a reason definitely to get a legal opinion on that and help an attorney that's familiar with self-directed retirement accounts, having them help you structure that deal to make sure that it would not be considered prohibited.
And Larissa, you know what that brings to my mind? One of these questions in the real estate investing world that I hear pretty often is, can I use my IRA to fund the earnest money deposit or to fund, the escrow deposit? And that's something we hear a lot. And to be honest, that's not an actual strategy that you can utilize if you're just trying to secure the property with your IRA money, but then purchase it 100% personally. You can't use your retirement account as a placeholder to that effect, because you're in essence loaning yourself money out of your retirement account. So that goes right into the regulation and the explanation that Larissa just gave. Again, that's a very common question. So if you had that in your head, it's just something I'm happy to address for you directly here. I see a few other questions we can jump into. If you're doing a deal with a disqualified person, say 75-25 or whatever percentage, can the disallowed person provide sweat equity? Actually, Larissa, did you answer that one? I'm sorry, I may have read that the second time.
Not specific. No, you didn't. No, not specifically. We talked about disqualified persons again, but no, disqualified persons are still not allowed to provide sweat equity. So I know it's not you, but you don't want to have, your son or daughter, for example, providing sweat equity on an IRA-owned asset where your IRA is involved or where their IRA is involved. They're still considered a disqualified person, and so no sweat equity can come from that individual or any business entities of theirs. So let's say your son or daughter is a general contractor and you say, well, my daughter owns the company, for example, but she's not going to be out there swinging the hammer. It's going to be her employees out there and her vendors. Would that work? And the answer is no. You want to make sure that you're dealing with unrelated third parties when it comes to your IRA. Even if your IRA only owns a small percentage, that's still very important, even if they personally own a percentage. So if it was my IRA and my daughter personally owning a piece of real estate together as partners, her general contractor business and license is not going to be involved in this property that my IRA owns a portion of.
Perfect. Thank you, Larissa. And I think the final question I see here that we have not gotten to, can a precious metal IRA be utilized for purchasing foreclosed properties? I own 100% of the SDIRA with Advanta, and I can purchase as me and or LLC. How would that work with the precious metals? How would that work with the precious metals? Would they be sold as a loan to be paid back in a timely fashion to eliminate any early disbursements? Well, really, it would be a strategy in that case to do within that self-direct IRA, either ideally completely separate from the precious metals. The precious metals as their own asset can't be leveraged, if I'm understanding the question correctly, for a real estate transaction. So yes, you would either need to liquidate the precious metal assets so that you can do the foreclosure property investment strategy instead. Or maybe if you have the ability to do a new money contribution based on your earned income for the calendar year, you could put up to 6,000 or 7,000 into your IRA as a new money contribution, and maybe make your real estate investments through that money. But the precious metal IRA, or the precious metal asset in the IRA, can't be utilized as a loan or as a leverage piece for getting into other investment strategies.
And that's important to note too, because a lot of times people are under the impression that this is a loan from your IRA making the investment, and it is not. It's based on the cash on your account. So if you move over 100,000 to Advanta and you buy 50,000 worth of precious metals, and there's only 50,000 in cash remaining in your Advanta IRA, then that's exactly how your statement is going to show you have available. So you have 50,000 as an asset in precious metals, and you have 50,000 in cash for your next investment. It is possible for an IRA to borrow to make an investment, but that is another webinar for another day, where there's some more moving parts that we won't talk about here. But certainly if you have more questions about purchasing real estate using a mortgage or financing basically to do so, Corey and I can certainly email you a webinar where we talk about that. We had another question just for clarification. Can you we did both say that you can't use your IRA money for the earnest money, or basically a placeholder for a purchase you're making personally, but the IRA can buy real estate. That's correct. So the IRA is going to be responsible for its own earnest money deposit, but if the IRA is not buying the property, you can't take the money out of the IRA and use it for an earnest money deposit. So I hope that clears it up for you.
Perfect. And one other question before we move on to my first case study. Can you invest IRA funds as a lender on a property versus being a part owner of the property? The answer to that is yes. There are a few different ways you could structure that. You could actually issue a loan to the property owner in a secured or unsecured capacity. So an unsecured loan means that you prepare and provide a promissory note saying, my retirement account is loaning to Jane Doe at whatever interest and whatever rates and payoff point that you guys decide upon. You as the account holder set all of the loan terms, and there is no security instrument in that case. So it is a little bit more risky. You definitely want to do the due diligence and know who you're lending to in that case. But you could also be a mortgage lender with your IRA. So you could loan and have that loan secured and recorded in the county in question, so that you have a lien against the property if that loan is ever defaulted or not paid out in full. So yes, instead of actually buying on the property as an IRA account, you can loan against the property or in unsecured fashion. And then another strategy similarly related would be doing a joint venture, where you have some sort of contractual agreement where maybe Jane Doe buys the property outright and you furnish money out of your retirement account as an investor. So your retirement account's an investor, paying for some rehab work or some updates to the property, or maybe it's raw land that you're paying out of your retirement account to develop. And on the back end, part of that joint venture agreement is that you are going to share the sale proceeds of that property based on a split that you and the joint venture partner agree to. So those are just some other strategies just to think about or consider, as we mentioned earlier, with the record keeping and kind of strategizing how you're going to do partnering transactions. Now, I'm going to get us back on track with the webinar here right now. I've got a case study just on basic partnering for a purchase of real estate, and then I'm going to explain a little bit about LLC use with real estate investing, and Larissa is going to cover a second case study on using an LLC for a partnering transaction. So the first case study here, we've got the same individuals from earlier in my slides. John Smith and Jane Doe decide to partner on a real estate purchase. John is going to use IRA money, and Jane Doe is using personal cash. So who does what in this scenario? John reaches out to Advanta, opens an account. It really only takes about 15 minutes to complete our application and gets that account open. And then John and Jane work together to make an offer on the property, making sure they use the proper titling I went over earlier. So Advanta IRA for the benefit of John Smith as to X% ownership, Jane Doe, an individual, as to Y% ownership. John submits a purchase authorization form to Advanta. That's a simple one-page document that we actually furnish and prepare. Your account manager with Advanta would help you through that if you have any questions. John has to mark all of the closing paperwork and contract paperwork as read and approved so that Advanta is authorized to execute on behalf of his retirement account. And once we receive that paperwork, your account manager with Advanta will actually coordinate the execution of the documents to go to the closing table, as well as the funding to the escrow company or title company handling the closing. On Jane's end, she basically does the same thing as an individual. She signs for her share of the offer. She reviews all the closing documents to make sure she's done her due diligence. She signs herself at the closing table and sends her funds along to that escrow or title company so that the property can close. Once that deed is recorded in the name of John's retirement account and Jane Doe, it should be sent to Advanta for record keeping. In this scenario, we could also let Jane hold the deed, but by default, we typically hold that in our safekeeping for good measure for the retirement account client. It would be a case scenario where John and Jane would have to agree and request if Jane wanted to hold that the recorded deed directly instead. Now, moving forward and overseeing this investment, John would request checks for expenses out of Advanta via his online portal or just by an email to his client account manager. The online portal is available 24/7. So if you have a bill coming up that you forgot about and you log in at 1 o'clock in the morning to submit it, we'll get that set up and the check out the very next business day. Jane would write checks for her share of the expenses. So again, let's just say you've got a landscaping bill and John and Jane share the property 50-50. John would log into his portal, submit a request for his 50%. Jane would send a request for her 50%. In these scenarios, what we see a lot of clients do is see John's check go directly to Jane so that she can put in an envelope both of their checks together and mail that along, or vice versa. Have John have his retirement funds check for the expense sent to him at his home or personal residence, or come pick it up at our office, and then have Jane send her funds to John so that they can pair that together. It just makes it easier for the vendor service provider so that they're not waiting for two separate checks in the mail. We can get those into one envelope. Again, this is part of the strategization we talked about earlier, where you may set up an LLC to make this easier or use a property management firm, because otherwise the vendor will get two checks and the tenants will also need to write two checks as they're paying rent. So if John and Jane have a $1,000 rent price point, $500 need to be cut and sent to Advanta IRA, and $500 needs to be sent to Jane Doe. Now, with these next two slides, I'm going to go over some information on the LLC partnering when you're purchasing real estate. So the IRA and non-IRA partners would be shown on the LLC's operating agreement as the same ownership percentage that they'd like for the LLC, not necessarily the property, because the property is going to be purchased 100% and outright by the LLC, but this is whatever contributions they're putting into the LLC. So that onset LLC purchase price or investment price is going to be a set price point. So if you put $100,000 and it's split, let's say 70-30 for this example, to be $100,000 total, and then you may need an additional $100,000 for further renovations of the property. To create that additional $100,000, because the ownership is locked in, John's IRA would have to put up $70,000 more, and Jane Doe would have to put up $30,000 more to keep that LLC ownership percentage where it was set. So keep that in mind as you're structuring and planning out how you're going to do your investment transactions. If either Jane Doe does not have $30,000 more, or John Smith's IRA does not have $70,000 more to contribute into the LLC, that's just something to be aware of and be mindful of as you're planning out how you want this transaction to take place and your LLC structure and ownership to be set. When you're adding more money to the LLC, that percentage can't be changed, specifically in addition when you're dealing with disqualified persons. Again, you can't buy out a disqualified person or sell off to a disqualified person any percentage of ownership or dollar amount. And one other key thing to be mindful of here is that most IRAs, traditional IRAs specifically, and also any beneficiary IRA, is going to be subject to what's called a minimum distribution or a required minimum distribution, an RMD. once that client has reached a certain age, or if it's an inherited account from based on who they inherited it from, whatever the decedent is, they're going to have to start taking money out of that account. So it must have the ability to be liquid, or you should have liquidity in maybe other assets that you're holding or other portions of your portfolio, because the last thing you want to do as a real estate investor is have your IRA be stuck in a property and a required minimum distribution come up, and you not want to take either a portion of ownership as a in-kind distribution personally, or sell the property so that you have cash to liquidate and suffice your required minimum distribution. So the real estate, as I mentioned on the last slide, is purchased in the name of the LLC 100% outright. So it doesn't matter on the deed or closing document that it shows the LLC is funded by John Smith and Jane Doe at X% ownership. They're invested in the LLC, and the LLC, as the investment vehicle, moves forward buying the property outright. The manager of the LLC coordinates all the expenses from the LLC's account with one check or one payment, and takes in all the income in the name of the LLC as one payment or one receipt of funds. And then the LLC really just needs to disperse money back out at those ownership percentages. So let's just say there's $10,000 liquid cash in this scenario, and John and Jane would like to take some of that money. If they want to take out 10,000 cash, then what has to happen is John Smith's retirement account receives $7,000 of profits out of the LLC, and Jane Doe receives $3,000 of profit out of the LLC, again, to keep the ownership percentage exactly where it was at the onset of the LLC. Now, at this point, if there's no other questions on the LLC, which I see one or two here, Larissa is going to start covering our LLC case study. Before I hand over, the question I see is, who is eligible to be the manager of the LLC? That is a great question. You, as the account holder and retirement account owner, can be the manager of the LLC. You can basically set anyone else as well as an additional manager. So it could be Jane Doe and yourself. It could be yourself and any other business partner that you have that's planning to oversee or work with this LLC for the investment. So it's pretty wide as for who is eligible to be the manager of the LLC in this investment scenario. There's not really too much rules or regulations. You could have an attorney, a CPA, any other type of trustee being the manager, or a co-manager for that effect as well. Is being the manager not considered sweat equity? That is correct. Being the manager is not considered sweat equity. There's a level of maintenance and oversight that you're allowed to do as the manager, as long as you're not like this gentleman in the picture down there tightening a wrench on the sink or anything like that. That would be the sweat equity component, is actually doing physical labor, moving around things, even changing a light bulb would be considered sweat equity. But from a management perspective, if you're just overseeing things, coordinating vendors, hiring, firing, coordinating who's coming into the house, that kind of is akin to like a general contractor in a contractor subcontractor relationship, where they're just kind of overseeing everything but not actually laying hands on any of the property. So that's kind of how it would be looked at from that perspective. And the IRA can own 100% of the LLC for the third question I see there. So that would be what's called a checkbook IRA, or a single member LLC strategy. That's something we've covered a lot in our webinar content and on our website. A multi-member LLC, which is what we're describing here to partner on real estate, is structured a little bit different because there's more than one member, and it doesn't necessarily have the exact same tax shelter as a single member LLC would. But that is just kind of a different topic for a different webinar that we've covered, and also on our website. And with that, Larissa, I will transition the slide and let you take over for case study 2.
Great, thank you, Corey. So now we're going to talk about how the LLC works and how that might assist you in easing the transaction for these investments. So as Corey mentioned, if you're partnering IRA and non-IRA funds in his first example, the tenants would be writing 2 checks. You would be sending 2 separate checks to your vendors. And although our clients have definitely made that work in the past, you can see using this type of structure how this would ease that transaction. In your tenants get 1 check. You would have one check to send to vendors. And also in this example, when you structure the LLC properly with the IRA as the member and the non-IRA partner as the member with percentages of ownership outlined, those percentages of ownership remain static in the LLC for the life of the LLC, and that's just inherent in this structure of the deal. And so a lot of times people will say, well, what if I want to own 50% of this piece of real estate and my business partner wants to own 50%, but in the next transaction, I'm going to only own 25% and they're going to own 75%. And the answer is, well, then you may have to form a separate LLC for the next transaction. But for the purpose of this case study and for the purpose of keeping the structure the same, whether it's 50-50 or 75-20, it doesn't really matter. But the idea being that once you form the LLC and establish percentages of ownership based on the amount of funds each party brings to the investment, then that will remain static for the life of the LLC in most cases, especially if it's a disqualified person that you're partnering with. So John Smith and Jane Doe decide they want to invest in an LLC to use an LLC to invest in real estate, and John decides he wants to use IRA funds. So we're going back to John and Jane and looking at the structure of their original deal and adding the LLC entity to it. So John again opens and funds his IRA account. He submits a purchase authorization form, basically telling Advanta IRA that he will be investing through an LLC. He's going to read and approve the operating agreement. And then once he does that, Advanta IRA will not only make sure that the IRA is properly represented as a member of that LLC, but then will also fund the LLC through the bank account that we are told the LLC now owns. Jane, in this example, is a non-IRA holder, so she might form the LLC or have a professional do so. She names herself as the manager. And again, as Corey mentioned earlier, you technically, as the IRA holder, could be a manager of that LLC. And just in this case, I didn't make John the manager, but he certainly could be. And if you wanted to talk to an attorney or a CPA about that, you are welcome to do so. But in this case, Jane names herself the manager and establishes the LLC checking account. And she wires her share of the money to the LLC. So again, what the important points here are going to be that the LLC is brand newly formed for the purpose of the IRA and non-IRA partner, that the manager is named, that this is a manager managed LLC, and that the members are on the operating agreement. So a lot of times people will tell me, well, I have formed an LLC before, but I don't have an operating agreement. And, I usually tell people, well, this might be a little bit different because the IRA does have to have an operating agreement showing that the IRA is the member. It's very important that there's paperwork in place for IRS purposes should that transaction ever get looked at, that we show the trail of paperwork that shows the IRA as a member of that LLC. So again, the operating agreement names the manager. The LLC should be declared as manager managed. The operating agreement will list the members and the percentages of ownership along with initial contributions from each to the LLC. Again, that's described as it was above. And just keep in mind that this titling or wording for the IRA making an investment is going to be consistent throughout. It is always going to be Advanta IRA for benefit of the account holder and the account holder's IRA account number, as well as their percentage of ownership. And of course, if they own something 100%, we don't put that. But otherwise, whether they're investing directly into the IRA, or excuse me, the property, or through an LLC, or through a trust, or lending money, if there is partnering involved, this is going to be very consistent, and that will be the titling that you see. If the IRA holder is not the manager, or is the manager, excuse me, if the IRA holder is the manager, that individual should not be paid or receive any current benefit for acting as such. And that's very important because, again, you want to make sure that you're structuring the investment within the rules. And the IRS rules or basically case law has shown us that the IRA owner can be the manager but should not receive payment or any current benefit for acting in such. And if you would like to look that up, the case that I'm thinking of specifically is Swanson versus Commissioner.
And Larissa, real quick before we jump into the details of this deal, someone asked, is there advantages in using a trust instead of an LLC?
There isn't necessarily advantages to one or the other. I think it's sort of an opinion, and people just like trusts or LLCs one or the other over the other, or We see a lot of individuals that like to sort of stack these structures. And what we would tell you is you should seek legal advice on the best way to structure the deal. I think maybe the reason we see LLCs more often than we see trusts is very simply because you do have to have a non-disqualified third party trustee for your trust. So meaning you cannot act as the trustee. You can't have your son or daughter act as the trustee or your mom or dad. It has to be somebody considered a third party unrelated to you acting as trustee. Whereas with the LLC, you could potentially be the manager or name a disqualified person as manager if you chose to. And that is something that we have seen case law on. So I think we just see more LLCs, but it doesn't make LLCs the right or wrong answer in our eyes. It's just another way to structure a deal. But you certainly could seek legal opinion on that, and we can also refer you to attorneys that have helped our clients with both of those in the past.
I would agree. I see the two different trains of thought there. Some people like the trustee and trust or real estate trust scenario differently or for their own purposes than an LLC. But that difference there is definitely having the trustee in place as opposed to having yourself or your business partner as the manager of the LLC. Now, a few other questions have come up while we were answering that. If you would like to cover those before the case study, or would you like to finish?
Yeah, no, go ahead.
Okay. Um, what would be the purpose of an LLC when the property is already held by Advanta? Isn't Advanta an LLC or Corp? Sorry, I missed that part. So I think what this person did kind of miss earlier in the webinar, which if you're signed in now, you'll receive a copy of this webinar via email tomorrow, and we can also email you the slide deck if you're interested. But what you may have missed is that the LLC structure gives you as the LLC member, or if your retirement account is a member of the LLC, the ability to consolidate some of the outgoing expenses and incoming income, as opposed to having to send with your partnership multiple checks out to vendors or receive and split up different income received from your tenants. So it's just a way to have a little bit more direct control in your hand as the retirement account holder, as opposed to the way things would have to be split based on the ownership percentage if you're doing the direct investment by Advanta. And then one other item, where can I obtain an operating agreement for this situation? Advanta cannot provide tax or legal advice. So in this context, an operating agreement would be considered legal advice. We do have attorneys and CPAs we could refer you to for an operating agreement. We also see clients commonly just do a Google search for the single member, multi-member LLC operating agreement. And as long as it fits the criteria Larissa went over in her last or second to last slide, that would be sufficient on our end. Our client account manager team will look over the operating agreement that you furnish and get back to you with any questions we may have and kind of help you with that. We also, as a client account management team, send out an instruction email once you tell us what type of investment you're looking to do that outlines many of the bullet points Larissa had on her slide 2 slides ago, as far as the LLC must be manager managed. You must appoint yourself and or anyone as the manager. And some of those bullet points we actually provide to our clients when they let us know they're working to do an LLC strategy. So we will be there to answer your questions and help make sure it's as smooth and simple for you, but we can't necessarily furnish or provide you an operating agreement or point you in a specific direction, aside from, again, the referral sources we offer, just, providing the reference to a general Google search for something of similar capacity.
Exactly. Thank you, Corey. So going on to the deal. So once Jane and John have invested into the LLC, so they've both participated into the LLC, moved their money into there, they can now make their investments. And so through that LLC, John and Jane make an offer on 123 Main Street in the name of the LLC. So they have established Sunshine LLC. And notice that the name of the LLC does not include the names of the members. A lot of times we get that question, like it should be Sunshine IRA LLC or something like that. And actually, we sort of try to stay away from that. We don't want to necessarily see Advanta or we definitely don't want to see Advanta named in the name of your LLC. We don't necessarily want to see IRA in the name of your LLC. So that information is going to go on the operating agreement, which is not necessarily public information. So the name of the LLC in this case is going to be Sunshine LLC. And again, Jane is the manager, so she's going to sign the offer as the manager for 123 Main Street. Once that offer is accepted and they go to closing, Jane is going to act on behalf of the LLC to sign any documents and go ahead and proceed with the closing. And then the piece of real estate is now owned in the name of Sunshine LLC. Again, by the nature of that entity, John and Jane own it based on their percentages of ownership named in the LLC. So if it's 50-50, then they own that property 50-50. If it's 75-25, so on and so forth. And so from there, Jane, as the manager, is going to receive the checks for rent, deposit them to Sunshine LLC's bank account, and she's going to write expenses directly, checks for expenses directly from that bank account. And again, just in the nature of the LLC, those checks are going out based on percentages of ownership. If they continue to make investments together, they can continue to use Sunshine LLC as long as they want to keep that percentage of ownership the same. And when they add money to the LLC, they will both add based on the percentage of ownership. So if they add it 50-50 and they decide that they want to buy another property for $100,000, and there is no money left in the LLC outside of the real estate investment they already made, then they would each have to add 50,000 to the LLC. And this will be important. It will have to come from John's IRA because it is not John that personally has membership in the LLC. It is his IRA. So his IRA would then need to transfer money into his retirement account at Advanta. And then from there, the money can be transferred to Sunshine LLC on his behalf to add more money for his share of the LLC. And just remember that the percentage of ownership will remain static based on the nature of the LLC. And so it's just going to stay that way until the LLC is at some point maybe dissolved and money is returned to the IRA holder and then to Jane personally. Something else that's important to note that if John, and I know Corey talked a little bit about this, is required to take minimum distributions. So if he's reached the age that the IRS says he now must take distributions from his retirement account, then money would go from the LLC back to the IRA and then from the IRA to John, and John would be requesting those distributions. He cannot simply get a check from Jane from the LLC to satisfy that required minimum distribution. That would be prohibited. So he wants to make sure that the flow of funds when it comes to IRS rules is in and out of the IRA to the LLC or vice versa, depending on what it is he's trying to accomplish. And just as Corey said before, if John and Jane are considered disqualified persons, then John cannot buy Jane out of her share of the LLC or vice versa. That would be considered prohibited. So partnering on real estate, and Corey did mention this earlier, that you can also use a third-party property management company instead of an LLC. So now looking back to our original example where the IRA partnered with a non-IRA partner at the very beginning without an entity like an LLC or a trust, you can use a third-party property manager to ease this transaction. So if your third-party property manager is we're in Florida, so Florida Property Management, then Florida Property Management would place a tenant, receive the income, and pay expenses on behalf of all parties that own that property. And so therefore, that would definitely ease the transaction. There would be one check coming from tenants and being deposited. There would be one check going from the property management company to any vendors for any work that needed to be done. And that definitely would ease the transaction. Now, just be aware, though, that if you're using a third-party property management company, it cannot be you as the IRA holder or somebody considered disqualified to you or your retirement account. So if John and Jane are partnering to buy a piece of real estate and John is using IRA funds and Jane is his spouse, then she would be considered prohibited from acting as the property manager. So even if she owns ABC Property Management Company, that is her business, she cannot act as property management in this instance. If the non-IRA partner is not considered disqualified, it is possible for the non-IRA partner to act in that capacity in that case.
And I will take back over here, just reiterating our key takeaway points. I do see one additional question in there I'll get to after I read these takeaway points. This is kind of a last call for anyone with questions to please go ahead and drop them in the question box. We'll answer those as we wrap up. But just to reiterate, I know Larissa covered these at the beginning of the webinar. Here we are at the end. And the key takeaway points are that there are many unique ways to structure real estate investments with retirement funds. We hope that we've covered them pretty efficiently for you here. And if you do have any further questions, just feel free to reach out and let us know. All of that cash flow in and out of this real estate deal must be split at the ownership percentage that was locked in when you bought the property or when you set up the LLC at the onset of the investment. And retirement accounts can partner with disqualified persons, but no sweat equity is allowed. So you, as the retirement account holder and or the disqualified person, cannot conduct any sweat equity on property that you're partnering on. It all has to be done by a handyman, trusted non-disqualified relative or partner, or an actual licensed and insured contractor for that effect also. The question I see here is, I don't have enough in IRA to transfer. Can I give my personal funds to LLC to cover the balance? The answer would be no, unless you're partnering into an LLC where your retirement account and yourself are partnering. That is a strategy you could do. We would implore you to kind of consult your legal professional for guidance on that, just to make sure that your actions or intentions with that LLC structure are within the IRS compliance. Someone just
Okay.
asked the cost structure of an Advanta IRA. We do have a cost structure where the client can choose one of two options, either being billed based on a per asset agreement or a total value agreement. I would implore that person to reach out to Larissa and I. We can answer any questions and provide you our fee agreement document directly. That's not something that we would necessarily discuss right here and now, but feel free to reach out to either of us.
Yeah, and Corey, there was another question about a non-disqualified relative. My partner is my brother, so not disqualified, is that correct? Yes, that's correct. So just take note, guys, up and down your lineal tree, those people are considered disqualified individuals, and then any spouses or business entities of those people up and down your lineal tree, side to side, brothers, sisters, aunts, uncles, cousins, they are not expressly prohibited, but just pay attention to the structure of the investment, because remember, if there's a current benefit to you as the IRA holder, that could deem that person a disqualified individual, and it could be a prohibited transaction. And I know we're really at sort of at the end of the webinar here, but just a quick example: if I were going to lend my brother money, and let's say he was going to borrow money for a real estate deal, I was going to get a first mortgage on a property he was rehabbing, we're getting fair market value interest on that investment, then that would maybe be okay. But if I had to lend my brother money because he could not finance a property to purchase for himself or rent, if he was an individual that could not rent for whatever reason, then there might be an intrinsic value to me lending him money, and now that might be considered a prohibited transaction. And so there's a difference between the two. So making sure that you're making investments for investment purposes, and if you have any kind of doubt of that or any question in your mind, then we definitely suggest you seek legal advice.
All right, thank you very much for covering that, Larissa. Just to wrap up here, I do want to let everyone know we do, as I mentioned at the beginning, offer a lot of free education. You will not see Advanta charging for our events or our video library or even our blog. So if you're interested in other webinars like this, you can go to YouTube/Advanta IRA and check out our very robust video catalog there. If we're in your area, in either the Tampa Bay area or Atlanta, or even myself up here in Western North Carolina, connect with us directly. We put on sometimes some in-person events like lunch and learns and other things where we're out networking in the communities. So you may be able to mingle with us there. And again, if you're interested in the specifics of the retirement investment industry, we do have a blog where we post blog posts. We have a podcast as well that our colleague Alex Perney is the host of. So a lot of free, beneficial, educational information that you could take advantage of at your discretion based on the topics that you have interest in. I mentioned it very briefly earlier. It really is a quick process to get an account set up. It takes about 15 minutes to complete our application. It's a 7-page application. Larissa and or I can help you through it on a phone call or with an email exchange, answering any questions you have. It's really quick and easy to transfer funds or roll over funds or make a new money contribution. And typically within 7 to 10 calendar days from completing an application, you can start investing. Whatever assets you find, or maybe you've already got a property lined up you want to invest into, Just a timeline perspective, you can typically, from submitting your application to getting that property under contract and starting with any investment strategy, get that all turned around within about 2 weeks, speaking conservatively. And with that, we'll leave our contact information here for 1 second. I see one or two more questions that we will go over here as we wrap up. And thank you all for your time. I know we're right at the 1 hour and 10-minute mark. So thank you so much for sticking with us. We appreciate you. The one question I see here, apologies if this was already asked, but can your IRA partner up with an LLC owned by yourself for investment properties? The answer is yes. That LLC can partner. Your IRA can partner into an LLC with another existing LLC, as long as that's all set up at the onset of the LLC operating agreement, and those are based off of the ownership percentage and the dollar amount going into this investment LLC. Larissa, any final words or any additional webinars you've got upcoming that you'd like to promote or plug real quick as we're wrapping up?
Yeah, next week I have a webinar on the 26th, July 26th, with Bill Cook. He's going to talk about structure stacking of for real estate deals. So that's going to be a great webinar. We also have webinars every week, and we also have our own networking event. So if you're interested in networking with Advanta on Zoom, you can check out advantaira.com/events and click on Pitch, Promote, and Prosper and join us for our networking event. How about you, Corey? Anything upcoming?
My next webinar is going to be August 4th, which is actually my birthday. I'm going to be covering some operating agreement basics for checkbook control. I'll be covering the checkbook control strategy in itself, but I'm going to have a specific focus on those operating agreement fields and characters that you're going to want to be aware of. August 23rd, we're covering international investing. And if you are interested in that networking event, I will be co-hosting the next one we're doing, which is July 29th. That's a Friday event, 12 noon Eastern to about 1 p.m. Eastern. It's called Pitch, Promote, Prosper. You can find it on our events tab under Virtual Networking Exchange.
Great. Thank you, Corey, and thank you, everybody, for joining us. We look forward to having you on our next event. Again, if you want a copy of this webinar, you certainly have a couple of seconds to pull the IRA handout out of the handout section, and also the recording will be available and emailed to you within the next day or so. If you have any questions, let us know. Thank you, everybody. Thanks, Corey.
All right. Thank you, everybody. Have a great day.